Welcome back to Market on Close. It's time to talk a little bonds, and we are joined by Larry Shover, the Chief Investment Officer at SFG Alternatives. Looking sharp this Friday, Mr. Larry. I think it looks like you're ready for summer. So am I, but as we know, it's not happening here in Chicago, is it, Larry?
No, not yet. It's not happening. And boy, this week is over, and everybody's looking forward to the busiest week of the year, at least news-wise, next week.
You think so? What do we have, Larry? Remind me. A North Korea standoff, a G7 continuation, a Fed day, PPIs. Yeah. What's most important to you, Mr. S?
Also CPI, retail sales, Empire, manufacturing index, industrial production, both here and in China. For me, it's really like digging into the details of CPI. I do think that consensus is a little bit aggressive with inflation prospects, and I'm not denying the fact that we'll see a blip in inflation, but looking below the details, I think it's going to be short-lived, and that's been my thesis all along with being long treasuries, being long the 10-year anyway, and also thinking that the curve will continue to flatten out between now and the end of the year.
All right, Larry, let's get into it here because once again, as you said earlier this year, you weren't buying the bond sell-off. Then we got down to, 276, about a hair away from 275. Are you taking the money and running, Larry, or are you betting on another rally?
Oh, I'm definitely betting on another rally. I mean, it wouldn't surprise me to see rates go a little bit higher from here. Why not? I mean, we're in this big consolidation zone. We have to just realize that the Fed owns the front end of the curve. That would mean everything up to 5 years, and 10 years and beyond, in my mind, is growth/inflation. And I think the warning lights are starting to go off, especially with the inflation narrative. And I maintain steadfast to be flat the curve, at least a 210 curve going flat by the end of the year.
So, Larry, within this next week, what's the most important piece of information? Because I know that we've got so much, and I know how convicted you are on this. So, and what here is the sort of catalyst? I mean, what's the bond market taking its cues from? Is it going to be something like CPI, or is it going to be an ECB that all of a sudden sounds super hawkish and opens up the door for the Fed to even get more hawkish, and suddenly that trade gets blown out?
Yeah, it's a great question. My money would be more on the ECB than the U.S. Fed because people, fully expect a rate hike. The presser, of course, could contain all kinds of granular detail to get people nervous. But at the end of the day, it's really the ECB. I mean, their data has stopped decelerating, and we know that it decelerated nice and hard from the beginning of the year. It hasn't bounced back as much as I hoped it would have by now, but definitely has stopped falling. So it's going to be very interesting. And we have to keep in mind that our rates really can't move that much until we get some movement from the German Bund and the like. And so right now, I think we're just trapped and waiting to see what happens with the ECB. Now,
Larry, just to be clear here for that, because what I'm curious about is whether or not there's really any reason for us to think that Mr. Draghi or the ECB is going to need to get hawkish. I know the data has not missed as much lately, but it's also not really beating by any means in Europe yet.
That's right.
Do we have any reason to think that they're going to change?
Well, I think it's thinking, what are they going to change to? Or what's the perception going to be? Because, last meeting, after reading through all the details, consensus said, Draghi is just a little bit dovish in his messaging, data dependent, et cetera, et cetera. Is it going to be more of the same, which will, propel some type of risk on rally here? Or will it be, let's get down to business, let's not meet this window, we have to start raising rates, and we're going to do it starting at the end of the year?
So, Larry, last point is that does any of the risk type of trade that might happen with a North Korean meeting gone awry, or a G7 that teams up against our president, I mean, however you want to phrase it, is that then a risk as well? Or for you, I guess it would be a positive thing if you're long bonds, because just last week, this Italian situation all of a sudden threw this huge bid into treasuries as a safe haven.
Yeah. Yeah, I think it's really the status quo because, I think with North Korea, with NAFTA, with all the moving pieces, the rise in populism, et cetera, I think it just begs for us to consider perhaps being long a little bit more cash than we're used to, perhaps being short the Russell, long the S&P, being long 10-year yield or 10-year bonds, and just waiting because I think we're just all asleep, me included, given how cheap implied volatility is, as shown by the VIX and other products around different asset classes.
Yeah. All right, Larry Shover, have a great weekend. Great to get your take. Always a pleasure chatting with you about bonds. I appreciate it, Larry. And if you don't follow him on Twitter, go check it out. He's got some great puppy pics up there too, Larry. All right, Larry Shover, having fun on a Friday. He's the Chief Investment Officer at SFG Alternatives.